Hello, my name is Malcolm Horn, one of the financial consultants with Alliant Retirement and Investment Services. Many people assume that they have to begin receiving Social Security retirement benefits as soon as they retire and stop working, but that's not the case. Retiring and claiming Social Security benefits are different. You have options, and learning about them may help you make a well-informed decision about when to start receiving your benefits. Before we get started today, I want to point out webinars that you're able to attend. Feel free to go on to our website, look at the upcoming webinars, and feel free to attend any of those. We also produce a financial podcast that you can listen to on various financial topics. And of course, our website has a lot of financial information if you want to learn about a specific topic. So as you approach retirement, when to claim your Social Security retirement benefit is one of the biggest financial decisions you'll need to make. Should you begin receiving benefits at your full retirement age, which could be 66 or 67? Do you claim it before your full retirement age, which you can do as early as 62? Or do you claim after your full retirement age as late as age 70? As important as your decision is, there's no one size fits all. Just because your uncle took it at 62 doesn't mean you should take it at 62. It's a personal decision based on your unique circumstances. Of course, sometimes the answer is simple. You may have to claim Social Security benefits as early as possible if you need Social Security income right away to meet day-to-day living expenses, perhaps because of illness, disability, or unemployment. But if that's not the case, if you have other sources of retirement income or you want to continue working, for example, you'll want to take the time to make an informed, well-reasoned decision regarding Social Security benefits. If you're like most people, you've paid into the Social Security system for years and you'd like to get the most out of it that you can. So to start, here are two major reasons why when you claim Social Security is so important. First, when you claim benefits can affect your overall retirement income. With pensions disappearing, Social Security remains a major source of guaranteed lifetime retirement income for most Americans. Once you apply, your retirement benefit will be locked in for the remainder of your life. So taking time to explore your options now can help you make sure you have enough retirement income later. The timing benefits can affect your spouse because he or she may be entitled to receive spousal retirement benefits and survivor benefits based on the amount you receive. So what are things that you should consider? You should consider your full retirement age and how the benefit is calculated, the amount of your future benefit and the effect of early or delayed retirement, how long you expect retirement to last based on your life expectancy, whether you plan to continue working, what are other sources of retirement income, is Social Security subject to taxes, how your spouse might be affected by the decision you make regarding Social Security. So let's first talk about what is full retirement age. Full retirement age is the age at which you receive 100% of your benefit. If you're born between 1943 and 1954, your full retirement age is 66. If you were born after 1960, your full retirement age is 67. If you were born between 1955 and 59, it's 66 and some months. Now, how is your benefit calculated? They look at the highest 35 years of earnings, and they index for inflation, take an average, and based on this average, they determine what your full retirement amount is. Now, you can claim your benefit as early as 62, but if you claim your benefit early, you will see a permanent reduction. If your full retirement age was 66, you would see a 25% reduction. If your full retirement benefit age is 67, you would see a 30% reduction. Here's an example of someone that has a full retirement age at 67. Their benefit is $2,000. Now, they can collect as early as 62, but their benefit is going to be $1,400, 30% reduction. You also have the option of delaying your benefit until age 70. Every year you delay your benefit, you will receive an 8% increase. Here's an example. Again, someone that has a full retirement age of 67. If they delay till age 70, they're going to receive 124% of their benefit. So again, full retirement age 67, their benefit is $2,000. Each year they delay, you see the increase to their benefit. So at age 70, they would receive $2,480. This final chart shows the range of monthly benefits you might receive depending on when you choose to begin receiving benefits. In our hypothetical example, if $2,000 is the full retirement benefit at age 67, the monthly benefit of $2,480 at age 70 is approximately 77% more than the monthly benefit of $1,400 taken at age 62, which is a pretty big increase. However, what this chart doesn't show is that you'll receive benefits for 8 years longer if you claim them at age 62 rather than age 70, and that can add up to a lot of money. In this example, if you receive $1,400 benefit for 8 years, you would have received $134,400 by age 70. So we return to the fundamental question. Is it better to opt for a smaller monthly benefit at age 62, but receive it for a longer period of time? Or is it better to claim at age 70 to receive the highest monthly benefit possible? Again, there's no one-size-fits-all answer. It depends on how long you can afford to delay receiving benefits and on how long you expect retirement to last. Which at the end of the day, no one knows how long a person's going to live. As financial consultants, it would make my job very easy if I knew how long you would live. 1 in 3 retirees will live to the age of 90. 1 in 7 will live to the age of 95. So at times we have to kind of think, do we have a long life expectancy? And does it make sense to delay our benefit till age 70? Or if we think we might have a short life expectancy, maybe it makes sense to take as early as 62. The next question is, do you plan to continue working or not? Now, if you decide to continue working and you are under the age of full retirement age, there is something that you need to be aware of, and it's called the annual earnings test. Because they will reduce your Social Security benefit if you decide to take your benefit early and continue working, depending on the amount of money you make, depending on how much you earn. But once you reach your full retirement age, none of your Social Security will be reduced. Under full retirement age, the rule is that $1 in benefits will be withheld for every $2 you earn over the annual earnings limit, $23,400 in 2025. The year you reach your full retirement age, $1 will be withheld for every $3 of earnings that exceeds $62,120. Once you reach your full retirement age, your earnings will not affect your benefits. You can make as much as you want. One of the most important factors to consider as you decide when to begin receiving Social Security benefits is how your decision will affect your overall retirement income plan. Most people have several sources of retirement income, including Social Security benefits, income from savings and investments, earnings from a job, and pension benefits. How much retirement income do you need? And how does Social Security fit into that plan? If you have less than adequate retirement savings or no pension, you may need to rely more heavily on Social Security income, leading you to claim benefits early if you need retirement income as soon as possible, or conversely, encouraging you to postpone claiming benefits so that you can earn the highest benefit possible. But if you have been able to accumulate retirement assets, you may have more flexibility when it comes to timing your Social Security benefits. For example, it's possible that claiming your Social Security benefits sooner rather than later will allow you to delay withdrawing funds from tax-advantaged investments such as 401ks, 403bs, or traditional IRAs, allowing them to accumulate tax-deferred a bit longer. Alternatively, tapping other retirement assets first may allow you to postpone claiming Social Security benefits, thereby allowing you to incur delayed retirement credits. Now, if you were not aware, Social Security is subject to tax. They look at something called provisional income. Provisional income is your adjusted gross income plus tax-exempt interest and half of your Social Security benefits. What that number adds up to determines how much of your Social Security is subject to tax. So if you're a single filer and you have provisional income over $34,000, that means that 85% of your Social Security could be subject to tax. As married joint filers, that number is $44,000. Now, this is not a 50% tax or 85% tax. That just means that portion of your Social Security is going to be subject to taxes. Based on your adjusted gross income, that's what determines how much taxes you pay on your Social Security. Now, they first started taxing Social Security in 1984. The first layer was 1984. The second layer was in 1993. These brackets have never been indexed for inflation. So you can see more and more people are paying taxes on their Social Security benefit. There's another important question you'll need to ask before you decide when to claim benefits. How will my decision affect my spouse? That's because when you begin receiving your retirement benefit can dramatically affect your spouse's benefit during retirement and thus your household income. Your decision can also affect any survivor benefit your spouse may be entitled to, and your spouse has decisions to make also. Together, you'll need to consider what the most appropriate combination of claiming ages is based on your ages, earnings, and life expectancies. Both you and your spouse have worked in jobs covered by Social Security. Each of you may be entitled to retirement benefits based on your own earnings record. As you'll recall, at your full retirement age, you're entitled to receive 100% of your full retirement benefit, and you can receive reduced benefits as early as 62. You or your spouse may also be entitled to spousal benefits. For example, if your spouse has had low lifetime earnings, he or she may be entitled to a spousal benefit based on your earnings record that is larger than a retirement benefit based on his or her earnings record. At your spouse's full retirement age, this spousal benefit will generally equal 50% of your full retirement benefit. However, that amount will be reduced if your spouse files early. For example, if your spouse's full retirement age is 67 and he or she files at age 62, the spousal benefits will only be 35% of your full retirement benefit amount. This reduction is permanent, so it's important to carefully consider the implications of filing early. And keep in mind that your spouse can't collect spousal benefits until you have filed for your retirement benefits. In addition to retirement benefits and spousal benefits, married couples must consider survivor benefits. When you claim your benefit can greatly affect the amount of income available to your spouse should you die, because your surviving spouse would generally receive the benefit that you were receiving at the time of your death, unless your spouse is already receiving a higher benefit based on his or her own earnings record. If your spouse's life expectancy is much longer than yours, this can be an especially important consideration. Survivor benefits may be payable as early as 60. However, a benefit reduction will apply if the surviving spouse begins collecting a survivor benefit between age 60 and his or her full retirement age. Here's an example that illustrates why it's important for spouses to carefully choose when to begin receiving Social Security retirement benefits. In this example, both spouses are able to claim benefits based on their own records. Spousal benefits are not considered. As this table shows, if both spouses choose to claim benefits at age 62, their joint monthly income will be a little over $3,000. But if both spouses wait until age 70, their joint monthly income will increase to a little bit over $5,400, a difference of $2,374 per month. That's over $28,000 a year. In addition, by waiting longer to claim retirement benefits, spouse 1 may increase spouses 2 monthly survivor benefit, since Social Security generally pays the surviving spouse the larger of his or her own retirement benefit, or the benefit his or her spouse had been receiving. Of course, this illustration does not account for the other factors that this example might need to consider, and your own situation and overall income plan will be unique. One strategy some people might consider in certain situations is the do-over or reset. This might be appropriate if you filed for early Social Security benefits before reaching full retirement age and regret taking a permanent reduced benefit. It also has the potential to benefit your surviving spouse, who might be eligible to claim a survivor benefit based on a higher amount. You are allowed to take this action only once in a lifetime, and the application to withdraw benefits must occur within 12 months of the time you made your original claim for retirement benefits. Moreover, you must repay all the Social Security benefits you and your family have received up to that point. Fortunately, you won't have to pay any interest. To reset your benefit, you must complete Form 521, noting the reason why you want to withdraw the application to benefits on the form. Social Security will respond to your request and notify you of the amount of benefits you will need to repay, and you have 60 days to cancel an approved withdrawal. Once this process has been approved and completed, you will be able to reapply for Social Security benefits at a future date. If you wait until full retirement age to reapply, you would receive your full benefit amount, and if you wait until age 70, you could receive your maximum benefits. This presentation explored some of the major questions that you'll want to consider as you decide when to begin receiving Social Security benefits. To recap, here are some of the reasons you may decide to claim benefits early. You may need Social Security right away. You may want to invest your monthly benefit or pay down debt. You may want to delay having to take funds from other retirement vehicles. Your spouse wants to delay claiming benefits. The choice is yours. Here's some reasons to delay your benefits. You want a higher monthly retirement benefit amount. You want to maximize survivor income. You plan to work longer. As a starting point, if you haven't already done so, I urge you to go to the Social Security website, where you have a couple of relatively easy ways to estimate what retirement benefits you might receive. First, you can sign up to access your Social Security statement online so that you can view a summary of your actual earnings record and an estimate of your retirement benefits based up to 9 different claiming ages. If you're already age 60, you also have the option of receiving this statement in the mail every year, about 3 months before your birthday. The second way to estimate your Social Security benefit is to use the retirement estimator, which is also available at the website. This calculator allows you to input various scenarios based on current law to estimate future benefits. And as you near age 62, you should also contact the Social Security Administration to discuss your options. Representatives are not allowed to give you advice about when to start your benefits, but they will be happy to explain your options and the rules that apply. When it comes time to apply, you can do that online, by phone, or in person. Small steps can enhance your financial life one day at a time. Thank you for joining me today.